Students, we are here in section 1.1 where we take overview of the financial markets. And in financial markets, it's very necessary to understand the mechanics and the history and the current situation in the stock market. So we know that our learning objective for this unit is to understand the importance of financial markets such as stock markets to a corporation and the financial manager's role as lies into these markets. We know that from the previous knowledge of finance that the role of the financial manager is to maximize the wealth of the owners, and the owners in the corporation is the stockholders. So the value of the owner's investment in a corporation is normally determined by the price of a share of a corporation's stock, that how much the price of that stock in that market. So for that we see, because the stock market is the basic for this. So here we go. We already know from the previous knowledge that the corporations are of two types. One is the private corporation and one is the public corporations. We know that the private corporation has limited number of owners, is a closed circle within family or with a closed circle of friends. The stocks, the shares are held, and they cannot sell in any market. Means there is no organized market for its shares for the private corporation, while for the public corporation, because it has many owners, because its shares are sold to general public, and its shares normally will be traded in an organized market that is called the stock market. So as I told, the value of the owner's investment in a corporation is determined by the price of a share of that corporation's stock. And where we will see the price of that corporation stock, we will see the price of that corporation stock in the stock market where that stock is commonly traded. So here are some the big stock exchanges. The stock exchange, or the stock market, or the bourse. These are the alternative terms used, but commonly we know that the stock market is there. So every country has a stock market. So these are the top 10 biggest stock markets in the world. You can see here. It's based on the total value of shares traded in number of billions of dollars. Right, its source is also given. If you want to see the further information about this, you can go on this website and you can see. So there are two kinds of markets, primary and secondary market. What is the primary market? Primary market is basically refers to a corporations issuing new shares for the first time of stocks and selling them to investors directly. So once it's sold, then these shares continue to trade between the investor, from one investor to another investor. It will change hands without the involvement of the corporation, and this market is called secondary market. So in that way we can say that the stock market or stock exchange is the secondary market. So we can see their traditional trading venues in US, because we are following US book. So we will take the example of US stock exchanges, and also these stock exchanges remain on the top for a long time. One is NYSE, that is New York Stock Exchange, and the second one is NASDAQ, NASDAQ. NASDAQ is basically, it stands for National Association of Security Dealers Automated Quotations, something like this. So if we go into the history prior to 2005, almost all trades on the New York Stock Exchange took place on the trading floor, that is located actually in Lower Manhattan in New York City. And there means they have market makers, as we see here, market makers. There we can see the market makers, and the market makers, who are the market makers? In New York Stock Exchange, these market makers are called the specialists. Basically, these are the individuals, or maybe the companies, who match the buyers and sellers. So in New York Stock Exchange, these market makers are called specialists. So what is bid ask spread, and what is the bid price, what is the ask price, what is liquidity? So we will see these in brief detail in summarized content. So basically these market makers are making the market available for the liquidity for those who are either having those shares of stock or who want to buy those stock. So these market makers basically they always stand and willing to buy the stock at a price, and they set that price. That price is called the bid price. Means the market maker buy at the bid price at any time they are ready to take at the bid price, and that bid price is was available to everyone, because we are talking about the history of the stock exchange. And similarly, as these market makers are ready to take the shares at a bid price, similarly the market makers are ready to sell the stock they have at a ask price. So ask price is basically the selling price for the market makers, and the bid price is the basically buying price for the market makers. So whenever any customer or any investor want to buy any stock, he can go there and can either sell or can buy. And these market makers made it available even there is no party on the other side. For example, if you go to the market and you want to buy some stock, so if nobody is selling, the market maker will made it available to you. So in that case, your stock will be converted to immediately converted to the cash, turned into cash. So that turning into cash is called basically the liquidity. So whatever the price difference between the buying and selling of the market maker for the stock, the difference they take as a profit, and that profit is basically the transaction cost for the customer or for the investor. And sometimes there might be included some commission also. Okay, this is how the markets were working. But the difference between New York Stock Exchange and Nasdaq is that in New York Stock Exchange there is a trading floor for this bid and ask. Means there are many people, there's a floor, and they're shouting this stock has this price. And in New York Stock Exchange, for every stock they have only one market maker, and there is a trading floor, and normally the trades are completed, means the buy and sell is completed on the floor. But in Nasdaq it is not like this. Means there is no trading floor, rather this market is done on the phone, and on the computers. And there are multiple market makers even for the single stock. So the market makers, even they also compete with each other for the same stock. And all the trades are normally completed on the phone or on the computers. So this is how the Nasdaq and the New York Stock Exchange is different. So this bid ask make profitable for the market maker. And normally you see, because this bid and ask price is normally set by the market maker, so they always keep some difference in the bid price and the ask price. And as I told, the bid price is a buying price for the market maker, while the customer always buy at the ask price, selling price, because when the market maker will sell, the customer or the investor will buy. So the ask price is always higher than the bid price, so they always pay higher price when they are going to buy, means the investor, and they sell always on the bid price, and that is bid price is the buying price for the market maker. So that is always lower than the ask price. So this way they make their profit. So we move on to the next slide. Now the new competition and the market changes, how the market have been changed over time. We will see that stock markets basically have gone through numerous changes in the last decade. In 2005, the figures told us that the New York Stock Exchange and Nasdaq exchanges accounted over 75% of the all trade in US stocks. But the same situation is not the same now. Since that time, however, they have faced increasing competition from new fully electronic exchanges as well as alternative trading systems. If you have seen the figure before, we can see that there is some exchanges with the name BATS, BATS. That's better alternative trading systems. So these trading systems are fully giving the electronic trading. So with the change in market structure, the role of an official market maker that is almost disappeared, because now all the transactions are occurred electronically with computers, and the computers normally match the buy and the sell order. So here now the new things come when the market changes. The limit order come. Now anybody can make a market in any stock by posting a limit order. And what is limit order? A limit order is an order to buy or sell a set amount at a fixed price. For example, an order to buy 100 shares of IBM at a price of $138 per share is limit buy order. So bid ask spread of a stock is determined by the outstanding limit orders in this new system, in the new improved system. The limit sell order with the lowest price is the ask price, and the limit buy order with the highest price is the bid price. Now the traders make the market in the stock by posting limit buy and sell order both. So when the collection of all limit orders is known as the limit order book. It is called the limit order book. Exchanges make their limit order books public so that the investors and also their brokers are working at on behalf of the investors or the customers, can see the best bid and ask prices when deciding whether to trade or not. Traders who post limit orders provide liquidity to the market On the other hand, traders who place market orders. Now, what is the market order? Orders that trade immediately at the best outstanding limit order is the market order. So, what I was telling, on the other hand, traders who place market orders are said to be takers of the liquidity. So, next terminology is the high frequency traders. Who are the high frequency traders? High frequency traders are a class of traders who, with the aid of computers, place, update, cancel and execute trades many times per second in response to new information as well as other orders, profiting by both providing liquidity and taking advantage of the stale limit orders. Stale limit orders, when any new information is arrived about a stock and you do not act immediately, then that order is called stale order, and people normally try to take the advantage of such stale orders. Now, what is the dark pools? Dark pools are basically alternative trading system that I spoke before. These are also called dark pools. Dark pools do not make their limit orders book visible, means you cannot see the bid and ask price. Instead, these dark pools offer investors the ability to trade at a better price. For example, the average of bid and ask price, saving the bid ask spread, with the trade-off that their order might not be filled. It means there's a trade-off with this hiding their bid and ask price. There is chance that there is trade-off that their order might not be filled. And what could be the reason for that? If an excess of either buy or sell orders is received, then this order may not be filled. So, what is the listing standard? Listing standard is whenever any corporation decides to list their corporation, their company in the stock exchange, to that their shares will be traded in that market is called listing. And listing standards means the rules and regulation should be followed before going to list your company in that stock exchange. So the listing standards is basically the outlines of the requirements a company must meet to be traded on the exchange, that their products, their stocks should be traded in that exchange. So now as we were talking about New York Stock Exchange and the Nasdaq, these both are very competitive in the listing. Some companies are listed in Nasdaq and some are listed in New York Stock Exchange. Just for example, Facebook is listed in Nasdaq. You all know about the Facebook, and NYSE, New York Stock Exchange. Twitter is listed in New York Stock Exchange. So there is competition between these both exchanges to get the good companies on their floor or on their listing. So there are many other financial markets, but we normally start with the stock market. The other two big markets are the bond market and the foreign exchange market. So these markets basically does not exist physically. Rather, these are simply networks of dealers connected by phone and computers. The bond market and the foreign exchange. Foreign exchange market is also called forex market, when you trade one currency to another currency. And then there is the commodities market. Commodities means the different things that we trade. These could be trading items or the food items like oil. I mean all kinds of oils: wheat, rice, soybean, cocoa powder, and all these things. These are traded in commodities market, and these are normally traded in physical locations. And one of the important market for that is New York Mercantile Exchange. Then derivative securities. Derivative securities, these are basically very complicated financial products, and these products are used to hedge risks. And these are also traded in some locations, and one of the market in US, very popular market, is the Chicago Board Options Exchange. So this is overview of the financial markets. Hope you will get the idea. Thank you very much.